Welcome to the Deep Dive, powered by TalkTickers. Our mission is simple. We cut through the noise of earnings calls to give you the crucial numbers, the strategy, and what it all really means for you. Today, we're diving into Brixmor Property Group, that's BRX, and their Q2 2025 earnings call.
Yeah, and it was quite the quarter for them. Really got some positive attention, I think. Shows real momentum.
Definitely. Brixmor really delivered a strong quarter. They beat expectations pretty significantly across some key metrics. Let's just hit those headlines first because they really set the scene. GAAP EPS, $0.28. That's a huge beat, like 33% over consensus.
Yeah, that's a big number right off the bat. And their Nareit FFO, funds from operations, key for REITs, that came in at 75.6 cents per share. Just a bit ahead of their own guidance midpoint, which suggests a strong execution, maybe even better than they expected.
Right. And revenue.
Revenue also looked good. $339.5 million, beat consensus by about 2.5%. So you're looking at year-over-year growth, probably in that, 2-3% range. Solid.
And the one that really jumped out at me was the same property NOI, up 3.8% year over year. What's impressive there, and I think this really speaks to how they're operating, is they did that even with a noticeable drag from tenant disruption. How did they pull that off?
Well, that really gets to the heart of their sort of transformation story. They were super aggressive in backfilling spaces left by those bankruptcies, Big Lots, Party City. And they didn't just fill them, they got better tenants in there, often at much higher rents. Plus, the rest of the portfolio performed well. So basically, the strength in new leasing and the existing base more than covered that disruption drag.
Makes sense. And the market noticed, right? The stock popped a bit on the news.
It did. Seemed like investors liked what they heard.
Okay, so let's dive deeper then. Beyond the headlines, into those pivotal financials and the operational strength. You mentioned leasing momentum.
Huge momentum. They signed 1.7 million square feet of leases, new and renewals combined.
And that blended cash spread 24.2%. Can you just break that down for us? What does a spread like that actually mean?
Sure. It means basically for all the leases they signed this quarter, the new cash rent coming in is, on average, 24.2% higher than the rent the last tenant was paying for that same space. It's a direct measure of pricing power. Shows how much demand there is for their locations. It's a really strong indicator.
24% higher. Wow. And the new leases were even stronger, right? Like 43.8% increase.
Yeah, the new leases were on fire. 43.8% jump across 900,000 square feet. And they actually mentioned it was the highest quarterly annual base rent from new leases in their history.
So not just filling space, filling it at record rent levels.
Exactly. That's the key takeaway. And it pushed occupancy up too. Leased occupancy hit 94.2%. And they set a new record for their small shop occupancy, 91.2%. Shows demand is broad-based, not just for the big anchor spots.
Which brings us back to that tenant disruption point. It sounds like they almost welcomed it, like Big Lots, Party City, Joanne. They saw opportunity there.
I think that's fair to say. They've already backfilled 80% of those specific spaces they got back. And here's the kicker. They filled them with stronger tenants, ones that drive more traffic, and they did it at rents over 40% higher than what those previous tenants were paying.
40%. That's not just recovery. That's a serious upgrade.
It's absolutely an upgrade. It's strategic. They're actively curating the tenant mix, replacing weaker links with stronger ones. It makes the whole center better, draws more shoppers. It's a smart play.
And this forward thinking seems baked into their pipeline, too. That signed but not commenced, the S&O pipeline, stood at $67 million.
Yep, $67 million signed up, but not yet paying rent. And crucially, $59 million of that is net new rent. It's not just replacing old rent, it's adding to the total.
So what does a big S&O number like that really tell us? What's the significance?
It's basically future growth that's already in the bag. Signed contracts. It gives them and investors really clear visibility into future revenue streams. They expect about $41 million of that to start paying rent through the rest of this year, 2025. That brings the total rent starting this year to $69 million, which is way up from what they thought earlier. Sets them up really well for 2026, too.
Okay, so that visibility is key. And it ties into something else they mentioned, having a low rent basis. How does that help them backfill accretively? Can you unpack those terms?
Sure. Low rent basis just means the rents they were getting historically in many spaces were below what the market would pay today. So when a lease ends or someone like Party City leaves, there's a big gap between the old rent and the current market rent. Accretive backfilling means the new, higher rent they get doesn't just cover costs, it actually adds to earnings per share, adds value. Because the jump in rent is so significant, it's a major engine for their NOI growth.
Got it. So old rents were low, market rents are high, big opportunity.
Pretty much. And they're also improving the leases themselves, like getting annual rent bumps of around 2.8% on new leases. And they're trying to ditch some tricky old CAM clauses, that's common area maintenance, and use fixed CAM more.
Right, fixed CAM. What's the benefit there? Improves the recovery rate, they said.
Yeah, so traditional CAM can fluctuate, makes it harder to predict exactly how much of those shared costs you'll recover from tenants. Fixed CAM sets a specific charge. It's simpler, more predictable for everyone, and it means Brixmor recovers a higher, more consistent percentage of those costs. Better for margins, less hassle.
Makes sense. Predictability is good. And underpinning all this, the balance sheet looks strong too.
Very strong. They reported $1.44 billion in available liquidity. That's cash and credit lines ready to go. And importantly, no debt maturing until June 2026. That takes near-term refinancing risk off the table, which is great in this rate environment.
And the debt ratio.
Net debt to EBITDA, a key leverage metric, is at 5.5 times. That's pretty healthy for a REIT. Shows they're managing debt well while still investing, gives them a ton of flexibility.
Flexibility to execute that transformative value-added business plan the CEO talked about.
Exactly. Which involves disciplined capital recycling, selling some assets, buying better ones.
Like that big acquisition they did just after the quarter ended, LaCenterra at Cinco Ranch. $223 million. Tell us about that one. Why LaCenterra?
Okay, yeah, LaCenterra, it's a big one, 409,000 square feet. It's what they call a grocery-anchored lifestyle center out in Houston in a really nice master-planned community. The key things are the tenants, Trader Joe's, IKEA, Lululemon, really strong draws. And the demographics. Average household income around there is like $151,000, plus it gets over 5 million visits a year. It's a top-tier asset in a wealthy area. That's the kind of property they want more of.
And the deal terms look good, too. They mentioned a low sixes yield and high single-digit to low double-digit IRRs. What's that mean in plain English?
Right. Low sixes yield means the initial return, the first year's income divided by the price, is around 6-point-something%, a solid starting cash flow. IRR, internal rate of return, looks at the total expected return over time, including rent growth and maybe the property value going up. High single-digit to low double-digit IRR, so maybe 8% to 12% or so. That's a very attractive projected return for this kind of stable asset.
And it's accretive because the current rents are below market.
That's the upside. The rents there haven't kept pace with the market, so as leases expire, Brixmor can bump them up significantly. That drives higher income, higher yield, higher value over time. It fits their strategy perfectly.
So sell off maybe a slower growth ground lease like they did in Q2 and plow that cash into something like LaCenterra with more upside.
Precisely. It's upgrading the portfolio quality and the growth potential. They've got $370 million in these reinvestment projects underway right now, targeting a 10% incremental yield, plus hundreds of millions more identified for the future.
That's serious capital being put to work. And it's not just traditional rent, right? They're looking at ancillary stuff too. EV charging, solar.
Yeah, they mentioned that. EV charging, solar panels on roofs, maybe getting smarter about parking revenue, like at Point Orlando. Individually, maybe these aren't massive revenue lines yet, but strategically, they're important. They diversify income, can improve margins, and honestly, they make the centers more attractive to today's consumers and tenants. It's part of future-proofing.
And speaking tenants, it seems like they're attracting some big names, higher quality retailers.
Definitely. They listed quite a few Sprouts, Nordstrom Rack, Ross, Burlington, Chick-fil-A, Sephora, Lovesac. These are strong national brands that are expanding carefully. And there's this trend they noted, seeing brands that maybe used to only be in malls or more high-end brands now wanting space in these busy grocery-anchored centers. Brixmor's capturing that.
Okay, so strong quarter, good strategy playing out, which led them to raise their guidance for the full year.
That's right. They bumped up the full year 2025 Nareit FFO guidance. New range is $2.22 to $2.25 per share.
And same property NOI growth guidance also up.
Yep, lifted that too. Now expecting 3.90% to 4.30% growth. That's a pretty strong signal of confidence from management about the rest of the year. Oh, and they also mentioned bad debt is tracking low, towards the better end of their expected range, which suggests tenants are healthy and paying rent.
So operationally, a really strong story. But it's interesting, you look at the stock, before this call, it was actually down about 5% year to date. Management even said they felt the valuation didn't reflect their execution. Is that disconnect common?
It can be, yeah, especially when a company is undergoing a significant shift like Brixmor's transformation. The market sometimes takes a while to catch up, to fully buy into the new story. Investors might still be valuing them based on maybe an older, more static view of retail REITs.
So how do they close that gap? Just keep executing.
Pretty much. Consistent results are key. Quarter after quarter of delivering on the strategy, hitting those leasing numbers, bringing that S&O pipeline online, completing redevelopment successfully. And clear communication helps too. Making sure the market understands the growth path they're on. If they keep doing that, you could see what's called multiple expansion investors becoming willing to pay more for each dollar of their earnings, or FFO.
And the broader industry environment helps a bit too, right? It's not just Brixmor in a vacuum.
No, definitely not. There's strong demand, especially from big institutional investors for these grocery-anchored centers. That demand is pushing property values up or compressing cap rates, as they say in the industry. So even with worries about the economy or consumer spending, these types of centers are seen as resilient. And retailers themselves seem committed to physical stores as part of their strategy.
Okay, so looking ahead, what are the main things that could keep driving growth for BRX, the key catalysts?
Well, number one is that S&O pipeline starting to pay rent. That's huge and very visible. Then there's leasing up the rest of those anchor spaces they got back. They expect a lot of that to happen in 2026, finishing their current redevelopment projects, which have good yields, and finding more smart, accretive acquisitions like LaCenterra. Plus, the fact that their watch list of potentially troubled tenants is smaller now suggests less drag from future bankruptcies. They really see that past disruption as paving the way for upgrades.
All right, now for that part of the show, let's get a bit speculative. Remember, everyone, this is purely illustrative, absolutely not financial advice. But thinking like a hedge fund analyst, seeing this whole picture, what's a bold but plausible trade idea based on this Brixmor story?
Okay, bold but plausible. Given everything we've discussed, the clear transformation REIT strategy, the strong execution, that visible growth from the S&O pipeline and backfills coming in 26, a medium-term long position in BRX, maybe looking out till late 2026, seems like the core idea.
Betting that the market still hasn't fully priced in this turnaround and the future growth.
Exactly. You're betting on that valuation gap closing, on getting that multiple expansion as the story becomes more widely recognized and they keep delivering. Now, to make it bold, you could pair that long BRX position with a short position in another retail REIT. Maybe find one that's less dynamic, more commoditized, perhaps. One that isn't showing the same kind of aggressive capital recycling or tenant upgrading that Brixmor is.
So a relative value play, betting BRX outperforms the more static players.
Precisely. You're betting the market will increasingly differentiate between the transformers like Brixmor and the ones just sort of managing the status quo. It amplifies the bet on Brixmor's strategic success.
Interesting. A play on strategic evolution winning out. Okay, so to wrap it all up, Brixmor Property Group delivered a really robust Q2. We saw exceptional leasing, smart acquisitions like LaCenterra, disciplined capital management. It all paints a picture of a company executing well. And that updated guidance shows they're confident this momentum continues.
Yeah, the key theme is that active transformation. They're not just passively collecting rent. They're reshaping the portfolio, turning challenges like tenant bankruptcies into actual opportunities to upgrade quality and rents. And they've laid out a pretty clear path for growth over the next couple of years. They're really making a case for being seen as a growth company in this space.
Absolutely. And just one final time, a very important reminder. Everything we've talked about today is for informational purposes only. It is definitely not investment advice. Please always do your own research and due diligence.
And maybe a final thought to leave you with. As you see Brixmor execute this transformation REIT model, think about how that might ripple through the rest of the retail real estate world. Could this become the new benchmark for how value is created in this sector as the market keeps evolving?
Something to chew on. Thanks for tuning in to The Deep Dive. Until next time, keep digging deeper.